the textbook problems, and those are inventory also. But or they have inventory and they have other stuff there too. But anyway, what I'm going to do tomorrow is I'm going to email out the chapter 1, 2, and 3 exam. It's just going to be basically the financial statements on it, and I'm going to send out an updated syllabus. So I'll send those out tomorrow. I'm going to postpone I usually give you like a week on the exam. I'm going to bump it out another week just because some people weren't able to come to the class last week, so as to kind of get everybody back on, give some breathing room to everybody. Okay, one more thing I'm going to add, and that is not that. Here we go. Turning in assignments, and we'll do this at the end of class. We'll at least get the inventory one done. But in Blackboard, under the assignments, now a lot of you've already turned this in. If you were in class, you turned in the chapter 1, 2, and 3. You don't have to turn in again. But we're going to turn in this one, inventories. We might get this one done. We'll see. But I'm pretty certain we'll get this one done, the inventories one. So this one will be, you'll be able to turn this in. Say cancel tonight. And that's pretty much going to be the way it is. And I'm going to change what I said, and that is that the exams, I think I told you guys in class that the exams, you can take them in class. I've been told that that I should not be doing that. That they all got to be turned in the same way, and you don't want the appearance of a favoritism for people that turn it in class. So anyway, we're going to turn them in class. The exams will be emailed to you. They won't be in Blackboard. So they'll only be emailed, and the reason being is that there'll be different forms of the exam. So it depends on what form of the exam you get is the one you're going to turn in. But we'll talk more about that. But as far as I know what I was going to say. I'm going to go back. So if you can't, especially if you can't open up the handouts in the email, you can get them in Blackboard. Hopefully you'll be able to download them there if you can't get them in, if you can't open them from the email account. But usually I'll email maybe like an hour before class for the Zoom meetings, what we're going to cover. But it'll also be available in underneath the assignments and exam submittals. It'll also be there. Any questions? Oh, wait,
Professor, this
yeah.
is Breeze. I just had a quick question. So for what we turn in at the end of class, do you want that? Like, do you prefer we print it out, handwrite it, and then take pictures, or would you be okay if we type in as we go?
You can type it in as you go. That's absolutely fine. You can also, however you want to turn it in is fine. Excellent question, actually. Yeah, you can turn it in. So you can even, if you want to print it out and write it in, that's fine too. Or if you even want to just write on notebook paper, obviously write down what number you're on, all that, and just take pictures of that. You can submit as many pictures. You can spend as many as you want. Let me go back to that. That's an excellent question. I'll show you how these are set up. Let's go into this one. So this is set up for the submittals here. You'll notice it's set up for unlimited attempts. Highest grade is taken. But the importance of that is that you can, if you want to turn in, if you want to turn in 10 pictures, you can. If you want to turn in, a scan, if you want to scan in a PDF, it could be multiple scans of PDF or a single one, either way. But you can turn in as many as you want. And if you turn in the wrong thing, let's say you turn in an exam or you turn in something and you realize it's not right, or hey, how come this isn't? Second here. Nope. So let's say you turn in something, maybe it isn't right, or you made a correction to it or something like that. You do not have to email me and tell, take it out. Well, you can just simply email in the one that or seriously, submit the one that the correct one. I've had people submit 3 or 4 of them, that's not that uncommon. What I usually do is I'll go to the last one, assuming that that's the one you really want me to look at, and I'll look at that one first. And if that one doesn't do it, then I'll look at the other ones. But usually I just go right to the last one. So don't worry about, oh, I got to take this out because this one I put this in wrong, or I submitted the wrong document or whatever. Don't worry about it. And I can usually figure out what's going on. So yeah, the if you do submit something wrong, don't worry about it. But again, you can submit as many pictures and all that as you want. There is a very important thing though, and I'm going to put that in. It'll be in the syllabus. I'm sorry, I'm mumbling here. My mouth is still numb. Um, let's put it down here. Okay, for submittals. So you can submit almost anything except, hey, eh, the only thing you can't submit is um, do not submit the following. Eh, uh, zip files. This is a Windows thing. Blackboard doesn't like them. And same thing with the page files for Apple. And what it doesn't, I don't know what it doesn't like. Well, I do know what it is. I think there's probably some kind of a security risk or something with those two. But anyway, those two files, they're basically the same. A zip file is the same as a page file. You take multiple things and put them together. Um, what will happen if you do that in Blackboard is it will never actually load. It'll keep going in as if it's trying to load. And there's nothing I can do. I can't stop it because it'll say, no, 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 this is a student trying to submit something. And I can't. So if you do that, I can't take it out. Only you can take it out. So sometimes students say, well, why, but what about this thing here? You're not grading. Well, I can't. I can't open it and I can't delete it and have you. So don't submit page files and don't submit zip files. Also, I learned that the Apple numbers, which is kind of like Excel, it doesn't like those either. And I don't know why that is. But for whatever reason, it doesn't like the numbers program. Now, if you do it in the numbers, anything in the numbers program for the Excel, that's fine. Just export it to a scratch that. Yeah, if you're in the numbers program, just export it as an Excel file and then submit that. You still use it. Just export it before you submit it. But yeah, you can take pictures. However you turn it in, is fine. I mean, you can write right in the document. You can print it out, write it on, take pictures of it, scan it. I'll take it any way you turn it in. Any questions? You can also enter it in that kind of archaic thing where type in your answer here, but that'd be no fun. Okay. So yeah, so submittals, this do not submit these two. These are, for whatever reason, uh, uh, Blackboard doesn't like them. Okay, let's go ahead and oh, I must have closed my thing. Let's get back. Okay, let's start with the inventories one. Oh, and by the way, I did include the solutions to chapter 1, 2, and 3. I don't usually do that because, but the meetings will be recorded and all that. But I did it this time because the meeting wasn't recorded. Well, let me go back. Yeah, any other questions on any of this? I'll send out the syllabus tomorrow. I'll clean it up and send it out. It's kind of funny. I think this is the fourth time I've taught this class. I've never taught it the same way twice. It's always been, it's been face to face. Then it was um, the Zoom. It was a hybrid, which they just called hybrid. They didn't call it face to face and hybrid. They just called it hybrid, which was like half of the you meet half the time and you do Zoom half the time. And then it was, I mean, we also did completely Zoom, and then which was only 8 weeks, and now this is face to face and hybrid, which I just learned is that you do it, you can do it full Zoom. Oh, I know what I'm talking about. And but we also meet face to face. If you're an international student, it's uh, for your visa, your student visa, sometimes it's required that you meet face to face a certain number of times. Now, if you have an advisor, they should be telling you. I can't make any decisions on that. It's completely out of my hands. But if you're your advisor, they'll know. If you, I'm for the most part, uh, they like you to go to class, but because if you go to at least a majority of the 8 classes, whatever, that you'd be okay. But if you think you don't need to come and you're an international student, that's fine. But clear that with talk to an advisor. The reason I say that, I had a student that didn't think she needed to come, and it turned out she did, and so that was kind of a problem. But make sure you talk to your advisor. If you're not going to come, make sure you talk to your advisor before you make that decision, just to make sure. Okay, that was a lot of talking. Okay, let's see. Let's go back to the handout. Okay. Um, we're going to be going over the international rules and the US rules as far as the inventories are concerned. And one of the things that we always, want to we generally don't want to compare the two because I don't really do that on the CPA exam, but they can ask you for either one. In the past, they used to do comparisons between the two, but they actually will just ask you either one, which means you have to know them both anyways. And so we're going to kind of do them together and highlighting kind of the differences between them, not because it's going to end up on the CPA exam, because at least what they claim is that they're not doing that anymore. But just as to make sure you know what the differences are between them. So if they do ask you, hey, how would this be handled under the international standards, Okay. I think we talked a little bit about this before. International standards are more judgment, US are more rule based. Going into the inventories, and here are the international standards, and we're going to kind of talk about those a little bit. Their international standards, this is one of the times that they are much more, they have a lot more guidance in the US, which is kind of unusual. Most time the US has way more guidance than the internationals. You know what? Actually, I'm gonna jump into something a little different here. I'm gonna tell you what the general rule is for the U.S. standards, and this is for anything that's an allocation. U.S. standards for inventory or any other allocation. The true standards really only have two criteria. which is kind of, I say, that's kind of unusual. So the two criteria. It must be systematic. Oops, it's not hiding my hand. And rational. Those are really the two key words. So when it talks about things like, well, inventory, or if it talks about depreciation or anything like that, it has to be systematic and rational. Systematic just means it can be repeated with the same result. So if I do it and let's say first in, first out inventory. If I do it, I should get the same answer as you do it. It's systematic. We'll get the same answer by doing it. And rational just means it makes sense. So these are really the two standards that we kind of use for the most part in US standards. Inventory is kind of a wacky thing for me. I when I started auditing, I got um, for whatever reason, I think on the first few audits or something, I got put in an inventory. Inventory is very big, for a lot of companies of manufacturing or selling stuff, wholesaling, retail. It's huge. If you like some, you look at a company like Walmart or something like that, they don't really care about the buildings or anything like that. What they really care about is the inventory, getting the inventory in, getting it sold. That's how they make their money. And so, and inventory is huge, and it's every day you look at Walmart, they have inventory arriving every day, they have inventory leaving every day. It's a constantly moving thing. And so it's kind of difficult to do. Anyway, so I think that's why I got stuck in the inventory auditor guy thing. I was helping somebody. And anyway, I became like inventory expert guy, not because I had any, you know, crazy desire to be inventory guy, but that's what I ended up being. But anyway, there's dozens of ways to keep track of inventory and inventory pools and all that kind of stuff. And we kind of in the CPA exam kind of narrows it down to just a few, but there are lots and lots of different ways. And some of you that are in inventory, I'm sure you may very well have very different ways of doing it. But anyway, so the international standards in this case give a lot more guidance than the US, because the US says, hey, if it's systematic and it's rational, go for it. International standards are a little bit more, give a little more guidance on it. Okay. Uh, so let's go and see the stuff that we have here. Uh, Inventories include the cost of purchase, cost of conversion, manufacturing, basically, and other costs, including design costs. This is one of the ones that we don't allow for in the US. Interest, if it takes more time, we allow that. And normal waste or normal spoilage. Hey, those are all things that we put in our regular inventory. And design costs are not allowed under US rules. Okay. Cost of inventories exclude abnormal waste, so anything above the normal. Storage, unless it's necessary for production costs. So in the US, we don't allow for storage to be put into inventory, storage costs during the production. But international standards do. We still account for that as a building or whatever and depreciate it and all that. Administrative overhead and selling costs, those are also no-nos. Okay, so let's go to, this is problem problem 1. Oops. I've already messed up my spacing. Okay, so let's go through these. International standards. The purchase of wood, would that be included in the inventory? Anyone?
Yes.
Yep. Yeah, so they're making desks. Wait, what are they making desks? Chairs. I'm sorry. Yeah, so that'll be included. I might as well do the gap. And yes, if we're making wooden chairs, the wood is included in there. Wood storage costs 5,000, international standards. This is going to be the yes, because it's part of the production process. So if it's part of the production process, the storage costs are included. So I'm going to jump in on that one and say yes. For the international standards, it is. For the US standards, they say no. Okay, conversion costs. Conversion costs are like direct labor and direct materials. So people making the chairs, are those costs allowed? What do you think? Is that a cost of the chair? Oh, come on, make a guess. Be wrong once.
I think yes.
Yep. Yeah. So anytime you have the direct materials, direct labor, all that kind of stuff, those will all be in there. So 32,000. And that's for both US standards and design costs are the wacky ones. So actually, when you design something for a specific customer, design costs can, and let's assume that this is for a specific customer, design costs can be put in there. So if you make a design, generally design costs are just part of like sort of like research and development kind of thing for the US standards. International standards, they say, no, that's part of the product. And in the US, we say, no, it isn't. Okay, how about finished chair storage? Okay, so we have this storage for the wood that we're using. So here's wood storage. That's part of the production. How about finished chair storage? What do you think? Actually, this isn't. Who knows why? Why isn't, if we're storing the wood,
I think it's because it doesn't like necessarily apply to the cost of making
that's
the
exactly
the
it.
wood. It's like in a separate separate area where like this is like your overhead for the rent or for the storage. So you kind of have to like separate that from the cost of making the material.
It's absolutely it. Yeah, it's not part of the production. These are already produced. They're done. So this is not part of the production. We don't put it into the cost of it. So this will be 0 and US is 0 also. Normal waste. We call this spoilage usually, but
Yes.
yeah. And this so normal waste is just what you'd expect to have happen. This is just part of the production. For instance, when I was at US Steel, when they make steel, they kind of roll it out on a big slab, and the the ends of them are usually kind of messed up. They have and they'll let you cut those off, and they'll sell those. They sell the ends, and there's people that'll buy them, for if there's something that's not critical to what it looks like, they'll buy those with the end parts of it. But there's a certain pounds of this, you get the slab and it weighs 40,000 pounds, and maybe 1,000 of that you can't really use. That's normal. Now, if it's more than 1,000 pounds, if let's say 1,000 pounds out of the 40,000 pound slab is normal. If it's more than that, then it's abnormal, and then that is not included. That's actually a separate a loss sort of thing. And that's for both countries. So if it's abnormal, if it's something you don't expect, then it is not part of the cost. It's sort of like a loss. So something happened. Okay, so it's for calculator. Hey, that's not my calculator.
I have a quick question.
Yeah.
So like for abnormal waste, I'm like managing a construction company right now, and we have like a lot of scrap.
Yeah.
And at the end of the day, we have to put that on the IRS statement. So um, I was just like wondering if we were like scrapping all of that metal, would we put that into the cost?
Well, yeah, it technically, yeah. So like, let's say you have, you buy so much wood and for the framing and all that, and or for the forms for the cement and all that. Yeah, those are the stuff that's excess. Would be simply expense. It wouldn't be it. The stuff that's normal for that should go into the building or whatever construction project you're doing. But if it's something, if it's an overrun, let's say, if it's an overrun, generally it doesn't go in there, but it'll still be expense. Now I'm not sure exactly what the IRS rules are. I'm sure they're pretty thorough, so I'm sure they have their rules on it. But yeah, generally, if we're accounting you know only those normal things that you expect. You expect it, the certain amount of it to not work out or not be used right or whatever. Those would be expensed. They might be put directly into cost of goods sold. If they're normal, they'll be put right directly into cost of goods sold usually. If it's not normal, it'll and it's material, it'll be broken out separately on the financial statements. But
Yeah,
yeah.
that's what we've been doing, just like breaking it out. Yep.
Yeah, and that's what I would think. Yeah, so yeah, you put it in separately. Yeah, but it'll still get written off. I mean, it's still a cost of it. It's just it doesn't go into the product. It isn't like it doesn't exist. It does. Uh, we got to do something here. I haven't been in the basement here for a while, so I'm going to give me 1 second. I got to go grab a phone. Yeah, someone sent me a text message. Yes, the the I gotta do something. I gotta make sure this is recording. Yeah, it's recording. Okay, so someone just sent me a text message. Is it being recorded? Yes, it is. Okay, good. Next week will be so much better. I promise. Well, we'll be in the classroom next week. Okay, so let's take a look here. $6,000. And over here, probably just subtract out the 6, is it 90? You know what? I did an error here. Let me check and make sure. I did do an error here. I'm sorry, the wood storage cost would be included for the US standards. Let me, I do have I did this earlier. Yeah, shoot. The wood cost would be, and I'll tell you why that stuck out. So this would really be what, 95? Yeah, I think it's 95. Yeah. Let me talk about the storage cost for just a second. I'll let make sure everybody gets that in. If it really depends on if it's necessary for the production, if they have the storage cost. The what's commonly this comes about is something like a winery. You know, they let them sit. You know, they put the wine in the vats and it sits there for years. Those costs go into the wine itself. So yeah, you know, if it's part of if it is part of the normal production, they can be put in there, and um, yeah, so that it's one of those things that it really depends on how integrated it is into the operation. But the international standards are generally a little bit more lenient with that. So it is one of those things that in the United States, even though it's not allowed generally, it really depends on what it is. You know, now I'm starting to doubt myself that maybe I did it right the first time. Uh, I think the U.S. standard, I think the U.S. standards it is allowed for if it's necessary for the production. That it is allowed. Anyway, I'll look that up just to make sure before I won't let you go away with the bad information. Okay, let's go to the one we really came for. And here are the big differences between the international standards and the US one. They don't allow for LIFO. This is the big stumbling block in the United States between them. LIFO is a kind of a strange method, and I'll talk about that later, but LIFO is a method that is it's a theoretical method. And so the US companies are allowed to use it. In some cases, the IRS requires it, and no place else on the planet allows it at all. So there's a stumbling block with the LIFO, and we're going to actually do a problem with the LIFO. So international standards do not use LIFO. And US companies can use it, about like 10% or something like that use it. But it's also used for some things it's required for taxes that it be used. These are kind of basically estimates. Standard cost method and retail methods are acceptable only as if they approximate cost. And if you think about that, you go, okay, so these are different you know, standard cost when you have a standard cost for items going into the production. And the retail method is one that they use the retail price to figure out the cost. But what the standard tells you is you have to know the approximate, you have to know what the cost is basically to see if it actually is approximate to these two standards, if you're using one of these other standards. So standard cost is when you say there's a standard cost for something, it's very common to use in the United States. For reasons of keeping track for management purposes, they use standard costs to see, you know, whether something's being done efficiently. It's generally not used for actual inventory. But international standards say, well, if it's close, you can use it. And same with the retail method. You count everything up at the retail amount, and if it's close to what the costs are, you can use it. But now that also suggests that you know what it is at cost, because how would you know whether it's approximate unless you know what the cost is? So they still use the cost method to make sure that those methods are adequate to estimate it. Cost of inventories are ordinarily not interchangeable. They must be valued using specific cost. Goods and services produced and segregated for specific projects should be use specific identification. They really get into identifying what things go into. And you must use the same cost formula for similar inventory items. You do not need to do that in the United States. You can do things differently in the United States than you may have one company, one business, part of your business uses LIFO, the other part uses FIFO, even though they may be in similar businesses. Okay, let's see how this all works out. All right. By the way, those of you that are taking 304, you're going to see a bunch of this. It's, yeah. Okay, so a foreign subsidiary sells toy cars and has the following cost in US dollars. Okay, so these are already converted into US dollars and uses the FIFO method. Okay, the sales are usually very easy to get. Whatever you sold them for, that's how much you brought in. So let's do the sales first right here. Okay, so we have our sales. And this is again, this is not going to be a difficult one to do. How many units did we sell? 160. And the price we sold them for was 15. Whatever that is. $2,400. Okay, so this is how much we brought in for whatever we sold. And again, the sales are usually fairly simple because whatever they handed you, that's what you put in there. So this is, oops, that's too much. This is money coming in. Now, you'll notice that the goods are a little bit trickier because it matters which ones you sold. They have two different costs. So which ones you sold will make a difference. Now, for FIFO method, first in, first out, which really is, when you say FIFO, first in, first out, it really is first in, first sold. So the first ones that, when they say out, what they're really talking about is sold. So, first in, first out, think first in, first sold. And that kind of makes sense. If you go through a period, well, if you sold something on January 1st, it must have come from this beginning inventory, right? It had to have. So first in, first sold kind of makes sense. This is probably the way most inventory is done. First in, first sold. Okay, so we'll come down here. So first in, first sold. So the first ones would be which ones? The ones on the 1st or the ones on the 16th? Which ones were there first?
On the first.
Yep. Yeah, so this will be, let's see here. The cost of goods sold, we'll say cost of goods sold. Oops. So how much did it cost us? So we initially start out that we need 160. So this just comes from here. How many did we sell? We sold 160. And so we go to our first one, our beginning inventory. Oops. So we sold 160. This is on 1-1. We had these on either beginning inventory. So how many did we take from the beginning inventory?
100.
Yep. Yeah, there was only 100 in there, so we took all 100. So this will be on 100 times cost was $10. So this will be 1,000. Okay. We still need the cost for how many? So we sold 160. We found the cost of 100 of them. So how many more do we still need to grab to find the rest of the costs?
60.
Yep. Yeah, so we still need to find the cost of 60 of them. I'm gonna do something with it. I'm gonna make that a special red color so that we know. Yeah, maybe we should do this. Okay, so initially we had 160. We found the cost of 100 of them, so we still need the cost of 60. So now, realize these are gone, right? Is there a strike through up here? Maybe not. Oh, here. You can hardly see it, but so these are gone. And these are never coming back. Once they're gone, they're gone. So we just sold those. They're never coming back. So the only ones we have left now are the purchase of inventory. On 116. Now we have 130 on 116. Did we sell all 130 of those? Yeah. We look up here, there's 130 sitting in there. Did we sell all of those? How many did we sell out of that layer? You already said it. We only need the cost of 60 more. Right? So we'll get the 60 from that layer. $12. $720. I better use a calculator. Yep, 720. Okay, so that's 720. And this is going to look completely stupid, but I'm going to put it in just because we don't need the cost for any more. We found the cost of all 160 of these. Right? We found 160 the cost of those. So this is the total cost of goods sold will be 1,720. So this will be our cost of goods sold. Using the first in, first out, or first in, first sold method. Okay, so we got our sales. We have our cost of goods sold. So now we can do our gross profit. So sales. I'm gonna capitalize those. So sales, we got money coming in of 2,400. Oops, too much. And our cost of goods sold, these are goods that are going out. And cost of goods sold, it's not dollars going out, but it's an asset going out. It's just not, it's inventory. And this inventory is leaving and it's not coming back. Now we're happy about it. We sold it for 2,400. We paid 1,720. And so this will give us our gross profit or gross margin. I can't remember what the book uses. I'll look at it later. Some books use gross profit, some use gross margin. They're exactly the same thing. Oops, what am I doing? Oh, don't do that. All right. Let's see. $2,400 minus 1,720. 680. May want to check that. Is that what you guys got?
Yes.
All right. Now, here's a question. How much is still left in our inventory? The 100 is gone completely. So these are gone. They're never coming back. But from this other layer here, we sold how many?
60.
Yep. Sold 60. So we still have, so we sold 60 of these. So we still have from that layer, I'm gonna
Still got 70 left.
Yep. Ah. See, so there's 70 left at 12, whatever that. Okay, so this is what's left in that inventory. And that's, I'm gonna draw lines through this because this is also, this is the only thing that's left. From the 16th, we still have 70 at 12. Okay, so calculate the end of the inventory. Let's see, we have units. And that's from our purchase. $70 times our cost. Equals 840, 840. So this will be our ending inventory will be this. This is what was not sold. Ending inventory is not sold, unsold or something. I don't know, whatever, however you want to put it, but that's what's left in it. Any questions? Okay, let's jump to the let's jump to the one that makes the United States the pariah in the world for this. Okay, so this is let's suppose that the US uses LIFO, last in, first out method. Excuse me. Now, last in, first out means that the last ones in were the first ones sold. Notice that at least initially, if you look at the flow of stuff, that's impossible. If you make a sale on January 1st, there's no way it came from the 16th. The stuff isn't even there yet. It's 15 days away from arriving. So the last in, first out method, there's no way that it mimics what, or is what goes on for a normal flow of goods. It can't be. They're not there. How can you sell them on the first if they're not there? So to assume that those are the first ones sold, that doesn't make any sense. It's a theoretical method. It's a theoretical method because economists will tell you that the most recent price is the most accurate when it comes to, excuse me, determining income. Sorry. That the latest price is the most accurate. So the latest cost. So they say, okay, the latest cost would be the last ones in. So if you're trying to get the most accurate income, theoretical income, you would take those last ones in, and that is what you would use. So it's a theoretical model. It's not, nothing flows like this. You don't go to the grocery store that's been open for 15 years and they have 15-year-old milk sitting on the shelf. It doesn't happen. So it's a theoretical model that says, okay, the last ones in are the best estimate we have of the real value of what we sold. And so that's what we should use for our calculations. It's the more accurate inventory. Again, no one in the world uses it because inventory doesn't flow like that. And this is completely theoretical. US standards, we can use it. And there's even some tax rules that say we have to use it. So, that's it's one of those weird things. The United States is really different than the world when it comes to this. And it'd be hard for the rules to be able to say get rid of it because it's actually required for some of the tax stuff. So, that's kind of where they're at. But anyway, we're going to go ahead and go through it and do it last in, first out. And again, if it doesn't make sense, that's as far as the flow of things, it doesn't. But it does make sense when you think about it as the most up-to-date numbers. This 12 is the most accurate number we have for the cost of this inventory. It's the latest number. This $10 is old. This is the newest number. That's what we should be using theoretically, economists tell us, for this. Okay, let's go down here. Let's do the easy part, sales. Same as before. Oops. So sales units, we still sold the same 160. This is exactly the same as before. It doesn't matter what method we're using. The price we sold them for was 15, exactly the same. And when everything's exactly the same, the number at the end is exactly the same too. So sales is pretty straightforward. Just like the first one. Now, the ugly part. Cost of goods sold. We still sold 160. And that is just coming from here. Yeah, do that one too. Yeah, I'll do that. What are you doing? uh, Grab it, move it. Okay, okay. I like programs before when they weren't so helpful, you know. Oh, you want it over here? No, no, I want it where I put it. Oh, you want it over here? No, no, no. Okay, so last ones in were which ones?
January 16th, 130 for $12 a piece.
Yep. Oops, scratch it. Purchase. Uh, oops, let's see. So it's on the 16th. So we're going to take 130 from here. We're going to take all of them. Multiply it by the cost, which is 12. And again, we're taking those last ones because economists will tell us that those are the more accurate actual amount that you know of what our determination of our income. So 130 times 12, whatever. 1560. And we still need, how do I put it up here? Need cost for, okay. Oops, sorry. So we still need a cost for what? 30? So we found 130 we sold 160, we found the cost for 130 of them, so we still need 30, so we must go here to the beginning. And we'll take 30 of those. Let's keep those capitalized. Taking 30 times 10 equals 300. And you don't need to put this in. Actually, whenever you do this, I can figure out what you did, but we don't need the cost for anything more. And so this will be 1860. So that will be our cost of goods sold. Okay, coming out here, sales. Money coming in, 2,400. You don't have to put the plus there. I'm just doing it to differentiate from the cost of goods sold. Oops. Cost of goods sold, these are goods that left the place. Now we're glad they left the place because we made money on them. But they are still gone and they're not coming back. And this will give us our gross profit or gross margin. And I can't remember which one I used. Gross profit. But 5, 6. That cannot be right. Oopsie daisy. 2,400 minus 16. 540. That looks more like it. So that's our gross profit. Our ending inventory will be, okay, let's see. He sold,
It's still 70.
yes. Sold 30, so minus 30 here, and so this will be 70 are left. And again, yeah, you're exactly right. It's still 70 units. So from our beginning inventory, we still have 70 units at 10. So this is our ending inventory. This is gone. These are 30 of those are gone. They're not coming back. And so we have 70. Okay. So do that every time. Oops. By the way, one thing also with this LIFO method is you may have inventory that sits around for decades. You know, and that's another reason why people don't like it, is that you know, if you never sell down all of your inventory, you could, oops, wrong number. You could have inventory sitting in there for 50 years. And it'll be some, you know, some number back from 1976, be sitting in there. So this will be our ending inventory is 700. Okay, so here's what you need to do if, oops, I need to get more space here somehow. Looks like you can take some here. Take some here. Okay. So what would the differences be between so for the income, what would the difference be? So we had 680 for the gross profit here. We don't know what the exact income is, but we know the gross profit was 680 for here, and down here it is 540. So 680 minus 540, 140. So our income will be 140. Yeah, so put a dollar sign in front of it. $140 less for US GAAP. And the inventory, if you think about it, should be the same amount. 70, and we had one up here. 840, yeah. So the difference is, so our inventory would also be, and the reason why we know it must be, we want the balance sheet to balance. If you take 140 out on one side, you got to take it out of the other side. So these will both be 140 less for US GAAP. And if you were combining these, along with your operations for the US, you would take out 140 from the international, whatever the international is reported. Question on that? Okay. So let's go ahead and take a break, and we'll say be back at, what do we have left here anyways? Oh, okay. That shouldn't take long. So let's say be back at 10 minutes from now. Be back at 7:17. We're not going to get to the second one. We're not going to get through it, I don't think. We'll see. We'll be back at 7:17. We'll finish this one up. And then we can turn it in. Yay. Okay, so we'll be back at 7:17.
Hey, Professor, could you
Yeah,
scroll up just a bit?
yeah.
Yeah, perfect. Thank you so much.
Oops.
Oh, on like C. Yeah, right there. Thank you.
Okay. Okay. Where are they on from? Wow.
Mr. Taylor, you're muted.
Sure, thank you. Some people enjoy it being muted. All right. I'm trying to. I've been racking my brains trying to find out where where I got that problem from. But I don't think that's. I think those storage costs. I don't think should be in there for the U.S. Yeah, but I will find it. Okay. So, lower of cost or market or net realizable value, I should say. This is the problem that we've had with inventory for, going back many moons, and that is that what you may have inventory on your books that is the value of it's gone down, especially with things like like a computer. A lot of times computer equipment, things like that will decrease fairly rapidly or whatever. But the idea is that something that is been on the shelf for a while, say maybe obsolete or something like that, the value isn't what it is, what it used to be. And so we know we paid for it, but we may not be able to recoup that money. So this goes back, years. Thankfully, the U.S. has the U.S. used the calculations for the way the U.S. used to do this were absolutely crazy. I mean, we could do them, but they were, there's a lot of steps involved, and there was a ceiling and a floor, and you had to be in between the ceiling and the floor, and all this stuff. So they've thankfully, they've gone with the international standards for this. And two, you got to remember too, inventory is not something that's there for 1,000 years. It's there for a very short period of time. So the point being is how you account for it. All the costs are going to go through the books somehow, and they're probably in inventory, unless you have several years of inventory on hand. They're probably going to go through fairly quickly. So for example, how you keep the cost of inventory for a grocery store that turns over every few days probably doesn't really matter. I mean, it's going to be sold, and it's going to be sold so quickly that whatever method you're using probably doesn't matter too much. So anyway, the U.S. standards are pretty archaic for something that's not, it's not probably not going to be there within a year. Whatever method you use is probably not going to be there. So they've gone with the international standards, and that was a very good thing that they did. It was, I'll put it to you this way: we'd have spent this whole class doing it the U.S. way in the past. But basically, what we have is this. The net realizable value is the current selling price minus any additional costs, and that will give us the net realizable value. We're going to compare that to, we're going to compare that to the actual cost. So in other words, if we can't get back our actual cost out of this, we're going to write it down to this amount. Whatever the selling price is minus additional selling costs. What are we going to get out of this thing? That's what this net realizable value is. So if it's less than the cost, then we're going to write it down to this. And that's kind of the basic idea behind it. So coming down here, there are a couple of things that we don't need anymore, even though they might give it to you on the CPA exam to test if you know that the new standards are. We don't need to know the replacement costs. That's another thing. You have this item that you're not selling, and now you go find a replacement cost, and then it's maybe it's hard to find a replacement cost because they're not selling anymore. And we don't need the normal profit margin. So these are really the only two things that we need here: the current selling price and the additional selling costs. Okay, so let's see what the net realizable value is here. We'll just do it right up here. How about? So the current selling price is 260. Let's put that in. Tab. So 260. Tab. Minus the additional selling cost of 20. Tab. Well, it goes to net realizable value of 240. Okay, so this is our, I'm going to make that bigger. So this is our net realizable value. It's 240. Yeah. So we're going to get 240 out of this thing. Okay, so let's bring this down here. So the lower of net realizable cost $240 and our historical cost. And historical just means what did you pay for it? Hey. Okay. Okay, so which one are we going to choose? Which one is lower? The net realizable cost, or excuse me, net realizable value? Let me change that. Oops, you change that again. So we have net realizable value 240 and historical cost of 295. Which is lower? Oh, come on, you guys are toying with me.
Historical cost.
Yep. So we're going to leave this at historical cost. We go, okay, we're still going to make 240 on it. Maybe it's not how much we wanted to make on it, but you know, we're still making money on it. Come down here, we say, okay, what do we do if it is? Oops. Let's say the historical cost was 300. Get rid of all this formatting. Okay, so if the historical cost was 300, which one would we do? Which one's lower? Yeah, you guys are sleeping, I can tell. All right, 240. So if the historical cost was 300, then the net realizable value. Okay, here is the big difference. And it comes back up to here. Write-downs are reversed when the selling price increases. Okay, so when the selling price increases, you can reverse those write-downs. GAAP does not allow the reversal of the write-downs. we had to be something difficult. We can't just give them everything. So without the reversal of the write-downs. So we still use it. We use our approach, which you know is good, very good. But we said, okay, if it bounces back, if the price jumps back up, we're not going to change it. So coming down here, you know, if this was the case, we wrote it down to 240, we're not going to write it back up. International standards would allow you to write it back up. So international standards would say this. Let's see, the net realizable value would be, does it jump up to 500? Okay, so price jumps up to 500, the net realizable value is minus 20 equals 480. So if we have the net realizable value jump back up to 4, and then now it's up at 480. What are we going to do to reverse that write down? How much are we going to reverse the write down for? Anyone? How much are we going to reverse that write down for? You guys, if we get this one done, we can turn it in. Come on, guys. Wait a minute. Okay. What are we going to do with it? So it's now up at 480. You know, we had to write it down up here. How much was our write down at number 6? Anyone? What was the write down at number 6?
Was it 3?
It was well, there's a difference between those two. So this is what we paid for it. We paid 300. We wrote it down to 240. So this would be a write down of,
60 bucks.
60.
yep.
Okay.
So we wrote it down by 60. And that's what we can reverse is the 60. We can't, you know, people say, well, you know, look at how much more it jumped up. It doesn't matter. You can only reverse it back up to the 300 at most. So this would be reverse the $60 write down. And so it would come back to, you know, the cost would be 300, back to 300. So the most you can only reverse out what you wrote it down for. For a gap, no reversal. No, we're not doing it. No reversal. All right. So if you did this on the if you did this on the file, you can simply save it and or you can take pictures of it. And I don't, you know, even if you did it on, you know, if you wanted to take pictures of it in your computer, you're going to take a picture. If you wrote it by hand, you do it on notebook paper, that's fine. You know, just make sure you number them so that I know which one I'm looking at. But and then we'll just go into the blank screen here. And if you click on inventories, let's see, you know, upload files, probably what most people do. You can also create it. This is, you know, this is like a blank, like a notepad or something. But if you want to just upload the files, you can just drag, and again, it's as many as you want to put in there is fine. You know, so if it's on your device, whatever it is, you can just browse them, take pictures, you know, whatever the pictures are, put them in there. And you know, some I've had people, you know, if you have a 10-page handout, you have 10 pictures, and it's fine. So you can also, you know, put that in, and if you did that notebook paper, take pictures of the notebook paper, submit those pictures, and you'll be done. The only thing you can't turn in, I hate being negative here, but the only thing you can't turn in are the zip files, page files, and also Apple, they have a program. I don't It's kind of like a, I think a lightweight version of called Numbers, I think. I've had one student that had it, but you can actually, if you export it to an Excel file, and it's also an Apple. I won't say this is a big problem because I've only had one student ever did it, but the numbers files it doesn't like for some reason, which is kind of surprising. You know, a lot of people use Apple stuff. But anyway, so you can turn this in, and that'll be it for that. Any questions? Okay, we're gonna jump to the other handout just because we can probably get all the inventory stuff out of the way. I'm thinking. We'll see. I want to take a look at this before I talk too much. There's only two problems here. Yep. I think we probably do these two problems. And then we'll call it a. Now this one we're not going to turn in. We're not going to turn this one in today. We'll turn it in next class. So this will be the chapter 4 textbook problems. Okay, so this is so give you guys a minute to get this one up. Why did I put that? I didn't put your name on this one. Why did I do that? I don't. I still want to find where I got that one from. Where I got that. I can't find where I had this one. For some reason in my notes I put in 5,000 and I'm not 100% sure on that one. I do know that like if it's something like a winery or something like that, they usually include it in there, but this is this wood storage cost. I'm not sure. I'll have to take a look at that. I would say for right now, believe it, but in the future, it might not be. Okay. So let's go to chapter 4, the textbook problems. This is the second handout. And basically, this has got two very similar problems for the inventory. And then it goes into long-term stuff, which we'll cover next week. Okay, so let's do this one. So lower of cost or net realizable value. That's what this stands for. I'm going to write that out. Can you do all this one? I don't know. Value. I'll leave it at that. So lower of cost and looking at historical cost or net realizable value. Okay, so cost is just that. Those are our costs. Oops. The following table provides information about each product, selling costs. Oh, here. Selling costs are equal to 5% of the selling price. Okay. So we're going to. I'm going to write that in 5%. So this is what we're looking at, 5% or 0.5, you multiply it by 0.5. So 160 times 5%. You should be able to do that in my head. Is it $8? I think it's 8, because 10% would be 16, right? So I think that's 8. So 5% of 160, 5% of 140 must be 7. Do you see where I'm getting those numbers from? Oh wait, let me ask that better. You see where? Does anyone not see where I'm getting those numbers from? So 5% of it, whatever it is, maybe these are sales commissions or something, I would imagine. 80 times 5% is $4. Is there anyone who doesn't see where I'm getting those numbers from? So it's just 5% of whatever the selling price. So maybe these are commissions or something. So maybe give, the selling price, we give 5% to salespeople or whatever. Okay, so net realizable value would be 160 minus 8 is 152. 140 minus 7 is 133. Oops, wrong place. 80 minus 40 is what, 76? Okay, let's see. So for the first one, what would be the lower of cost or net realizable value? Oh, come on. Which one is it?
NRV.
Uh, I think the first one's going to be the lower of those. I think will be 130, right? Whichever one is the lowest.
Sorry, I was looking at the highlighted.
All right. All right. Okay. Yeah. No. So yeah. So this would be the. I should do these differently. I might do something different here. We'll make those green now. Okay. So, and that's the cost or historical cost. Yeah. So this would be 130 will be the lowest. And again, this one is, what this is basically saying is it's okay, right? We paid 130 for it. We can still sell it for 152, so that's okay. How about product 202? Which one is the lowest?
133.
133.
Yep. And 303?
76.
Yep. Okay, so this is our cost. All these together will be our cost over here. I should be able to do that in my head, but I'm not that good at the beginning of the week, and now it's even worse. 390. Okay, so this is 390. So this will be our total cost is 390. Now this one's a hodgepodge, but it's gonna be less. It has to be, right? 3 plus 6, 339. I'm gonna make that turquoise. Just because. So because it's not, it were all one of these or the other one. So this is obviously a mixed. So okay, so determine the amount at which B should report inventory on its balance sheet. That would be the lower of cost or not reliable. So that'd be this. Oops. Yeah, let's put a dollar sign in front of there just for yucks. So we should have it on our balance sheet at 339. Make the required journal entry to write down the inventory. Okay, so the write down would be for how much? It would be for 390. Oops. Eh. Minus 339. We have lots of space here, just in case I need it for some reason. 390.
51.
51? Thank you.
Yes.
So this will be the write down. Oops. I'll make it red. So we're gonna $51 write down. Okay, so they tell us to use the inventory write down expense. December 31st, year one. That was 2025 years ago. All right, so let's see, this is 12/31. Hey, what happened? Oh, 12/31. Inventory write down expense. Okay. If you want. That dog you hear barking is a little tiny dog pushing a big dog around upstairs. And yes, it's really funny. All right, inventory valuation allowance. Okay, so this is gonna be a contra asset. This would be a contra asset for inventory. Oops. Or a contra inventory account. So, oops. So let me put this in and I'll kind of show you. So this is what this would look like on the balance sheet. Look really small. Let's make these bigger. So on the balance sheet, it look like this. We'd have inventory at cost. Oops. Inventory cost. Oops. $390. And then we'd have this inventory valuation allowance. And so here we'd have something along the lines of net inventory or inventory. Let's just say net inventory. Hey, look how small it is. $339. So this is what that would look like on the balance sheet. It'd be in the assets. And it would look like that. They may even just do this and put this in the notes somewhere. That would be probably be a common thing to have. But the net inventory would be the 339. This. Okay. Any question? So we're probably still going to leave it at cost. And one of the reasons why you probably want to leave it at cost too is that it's possible you might have some recovery on here. And so, this valuation account would go down. Okay, so let's go to the next one. Continuation of problem 15. December 31st, year 2. Oh, okay. Hey, we could have just looked down here. Okay, so let's see here. Is this the same 5%? It is. Okay, so okay, so 5% of 180. Well, 10% would be 18, so this must be 9, I think. If I get these wrong, by the way, feel free to say it or even put it in the chat if you'd rather not. And 140 times 5% is 7.
Yes.
Good. Okay, so this is net realizable value is 171. 152. And 133. Okay, so what would be the lower of cost or net realizable value for the first one?
171. Sorry, 130.
Yeah, no, 130, right? Sorry, it was flaking out. I was looking at something else. So this is 130. How about for the second one?
What's the rate?
Uh,
152.
Yeah, and I think someone's looking at the other one. So this will be, yeah, 152 would be what we put in that one. And this last one would be which?
100.
100. So notice that we can only write it back up at most to the cost. We can't go over the cost. You know, even though this one is worth a lot of money, whatever, we can't go over that. So this should be so this is well, it's the same as before, right? 390. And this would be 382. Oops. So we haven't recovered all of it, but we've recovered some of it. So we want this to be 382. That's what we want on our balance sheet. How much are we going to reverse it for? Now, this inventory valuation allowance, this has in it $51 from last time. So I'm going to put that, I'll put that here. I don't know how to put that in so it looks right, but so we currently have $51 sitting in there. That doesn't look very good. I don't know. Okay, so let's put it like that. Don't do that. It's the same as the other one. That's the hardest thing about the international standards is the, you know, what color do you use? Okay, so what are we? How much are we going to have to take out of our allowance? There's 51 in there. How much is it really being written down for in this current year?
Wait, 8?
Yeah, so it'd be 8. So is that 51? And let me see, it should be 8. So how much do we have to take out? Was it 43? I think it's 43. So we have to reverse out. Okay, so the valuation account, is it going to get debited or credited? So here it is from last time. Okay. Okay. So if we're going to reduce it, are we going to debit that account or credit it?
Debit.
Debit. Yeah, for what did I say? What, 43, right? So this will be debited. So the inventory allowance, valuation allowance would be 43. And the reversal of inventory right now in expense, kind of a wordy. I'm just gonna abbreviate it, EXP. Reversal of inventory right now in expense would be 43. How would your answer be different if Beach used, I think this is supposed to be Gap. So it looks like, oops, US Gap rather than ICERS. How would your answer above differ? No rate down, or no rate up, no reversal. we would just leave it at what it was. US GAAP does not allow for you to recover it, or, company to recover it or whatever. And we will stop here. Hey, look at that. We got a minute spare. See, we got you guys out early. Isn't that great? So stop here and go ahead and save this. But we're going to cover the rest of this. We'll start on this next time. Let me back out of this one so we can kind of take a look at it. Yeah. Oh, no, not there, not there, not there. And again, you can only write it up to the cost. You can't write it above the cost. So, no matter what these are, how big these get, you can't go above this. This is sort of like the ceiling. This is as high as it gets, is the cost. It's the lower of cost or net realizable value. And if the net realizable values, if they're all higher, then it's just cost. And again, this is so much easier than the way it used to be. Okay, any questions on that? Okay, so what I'm going to do next is, well, I'm going to see where I got that one. I'm going to see where I got this one from. That, for some reason, looks funny to me. I mean, I know for some things that they do include that in the cost of it for like wines and things like that. But as far as just plain old wood storage, I'm not sure if that would qualify. And then, so here's what I'm going to do. I'm going to, tomorrow, I'll make up a new syllabus that will be more comprehensive and tell everything that we just went over. But also, oops, I will send out an exam, but it's not going to be due. Usually I give you a week to do it. This one will be done. We'll be doing 2 weeks. So you'll have plenty of time. And I like to do that a week ahead of time. I should probably tell you that I like to do that because I like to have people be able to ask questions if there's something, it's usually easier for you if there's a question, and likely there'd be questions with other people too. So if you have a question, I don't like, well, it says this. What does this mean? Then we can talk about it. And you still have time to turn it in, the next day. And by the way, one more thing about the exams. You turn in the exam. I'm not going to grade it until it's due. I might do the only exception to that might be the first one that we did, 1, 2, and 3 one. I'll grade that one probably as you turn it in. But for the most part, I don't grade them until the due date. And what that means is, let's say you go to class, you've already turned it in. You go to class, since people start talking about it, you realize I did it wrong or I could do it better or whatever. You can turn in a second one, and I'll take the highest one. So as long as it's not graded, once it's graded, I'm not going to change it. But if it's before it's graded, if it's before the due date, you can certainly change it. And I've had people that have, been in class and they said, well, wait a minute, you mean this? And I'm like, yeah. And they've gone in and changed it and got the higher grade. And quite honestly, people say, well, wait a minute, is that right? If you learned it during this class, then it is right. I mean, if you learned it, hey, that's all we need. So, it's not like, oh, I made a mistake and, never could be fixed. Any questions? Okay, and I'll send that out. And next week, wait a minute, I'm going to check and make sure I got this. No, not that. Not that. Next week we are, for those of you that want to come face to face, I will be in the classroom next week. We will also be having a Zoom meeting. So next week it'll be Zoom and face to face, and any of the face to face ones will also be Zoom meeting. So next week, face to face will be in room WB3 or 911, and also be Zoom. So if you're an international student and you need to attend, plan on attending it. If you just want to attend it, a lot of times I have people who work downtown. They say, "Oh, I'd just rather come over, get it done, turn it in, and go home clean." That's fine too. So Either way is fine with me. But we'll also do it for Zoom meeting. Any questions? You guys had enough?
Professor,
Yeah,
I have a question, but oh, sorry. Mine can wait after class though.
okay. Anyone else?
Professor, when was that exam due again?
It's not due for 2 weeks. It's
Okay.
due on the, well, let's put it back up. It's due on the 13th, I think. Let me take a look at it one more time. Not that. Yeah. So I'll get it out tomorrow. Usually I give you guys a week. Usually, if this was a normal, I don't, normal, whatever, I would say, here's the exam. It's due a week from Friday. But this one's gonna be due 2 weeks from Friday, just because the first day kind of got messed up there. And by the way, that's my, I should have asked. I should have asked about that. But anyway, because I know we do that for we run classes this way for the graduate program. I didn't know that we were also doing it the same way for the undergrad. In the past, we did the undergrad different. And by the way, if you're wondering, well, what should it really be? It's actually purposely written. The guidelines for hybrid classes are, it's up to the department and the instructors, is the way it's written. So, and I think it's just to be flexible with whatever the needs are of the students and the needs are of the program. Any questions? Oh, I just did something.
I don't have a question, but I definitely appreciate the flexibility. So thank you for figuring
Yeah,
that
yeah.
out.
And by the way, even if you want to attend it, and but you're having you can't get here, or whatever, it's bad out, it's snowy, and you're whatever, you don't have to come. You can do it by Zoom, and all of them will be recorded. So even if whatever, you're stuck in Seattle in an airport or something like that, it'll still be recorded. You can still look at it. You can still get the handouts. You can still do it.
Awesome. Thank you. Have a good evening.
I will. Any other questions? And I'll stick around for brief. Any other questions?
Thank you. Have a good night.
All right. Good night.
Thanks, Professor. Have a good one.
Thank you, Professor.
Hey,
Thank you.
Thanks, Professor.
no problem. Thank you.
Professor, I think you said the recordings will be posted after this class, right?
Yeah.
Or okay, because I was doing the inventories worksheet on my iPad, and then when we came back from break, I opened it back up again and it deleted everything we did before
Oh
the
no.
break. And I was like stressing out
Okay. Well,
during
and so that was everything we did after the break. If you want, I can put it on the screen. You want to take screenshots of it?
yeah, that works too. Yeah, because I
That would
did
probably be quicker.
everything.
Okay, let
Okay.
me go to so this would be the first stuff we did, right?
Yeah, everything after the break I did. It was just before the break, which was I think before.
Okay, so that would be this, the first things we did, right?
Yeah.
Okay, so go ahead and take a picture of this. I want to look up this one. I can't find where I got that one from. I can't find where I got that. Anyway, I'll look at it. Oh, I didn't put it on the screen. What am I doing here? Attention, I'm sorry.
No, it's okay. I
Here we go.
wasn't sure.
Okay,
Okay.
yeah, no, so there's if you want to take a screenshot of that.
Yeah.
Okay, got it.
Yeah.
Let's go to maybe do this one in two. You want to do it, or do you want to do it all at one? I don't know.
We could do it in two. That's okay.
Okay, yeah, my so there is the kind of background on it.
Yeah.
And this is kind of the rest of it.
Okay.
And now for the wacky one, the LIFO.
Yeah.
And the rest of the wacky one, the LIFO.
Got it.
And well, you know what? I just realized, I don't know if you want to put it, it probably doesn't matter too much, but this is the, oh, no, no. And then down here, if you want to This would be the adjustment for the US GAAP.
Yeah, got
Okay.
that one too. And then this is everything I got, I think. Let me just double check. I have this here.
You want to go and take a picture of it? It's fine if you want to take another screenshot. It doesn't matter.
Okay. We got it.
And
Got it.
I think that's the last of it.
Okay.
Did you need their handout or no?
No, it was just this one.
Okay.
I think also I know you had something in the very first page all the way at the top. I forgot what it was. It was like right under the title.
Oh, okay. On the first one.
Yeah.
Oops, that's not it. Take a look.
I think it was I think it was all the way at the top. The right under the title you added.
Oh, yeah.
Yeah.
Good.
Yeah, that was it. That was the last
I'm
thing.
glad you remembered it. Yeah, US GAAP is basically for any kind of allocation, whether it's inventory or depreciation, whatever. The real test is just systematic and rational. Yeah.
Okay, perfect.
Okay.
Okay, thank you, Professor.
All right.
We'll see you next week.
All right. Yeah.